everyone. You're watching Stockbusters on TFNFinancialNews.com. I'm your host, Sandy Franks. There's probably nothing better than opening your current statement and seeing positive numbers on stocks you suspect it would rise in value. But then on the flip side, there's nothing worse than seeing a stock bleed red ink all over your portfolio, robbing you of precious returns. That's the moment when you utter a few unpleasant remarks and wish you hadn't bothered to invest in the company at all. But what if you knew in advance what stocks to avoid? Well, that's what Stockbusters is all about. Today, I've invited Ann Sosnowski, editor of Diligent Investor, to help steer you clear of a stock that has already fallen 95% from its March 2000 high. Ann, thanks for joining us.
Thank you, Sandy.
Now, from the briefing you sent me, you're not a fan of Sirius Satellite Radio, correct?
No, not at all. I mean, the company's been in trouble for years. From the moment I heard about Sirius spending millions of dollars for Howard Stern, I knew that this was the end of the road for them. Sirius has had a short timeline of success in the late 90s, but found itself in extreme debt by 2003, making shareholders sell their stocks back to pay for the $700 million in debt it had already incurred. The company is still at the bottom of the barrel. Its profit margin is negative 173%. Its return on equity is over negative 1,700%. I mean, it'd be hard to find a stock like that anywhere else.
Those are miserable numbers.
I'm sorry?
Those are miserable numbers.
Those are miserable numbers. Going into 2008, the company is still going to be unprofitable, with a table full of analysts expecting a loss of 28 cents per share. It really seriously has the worst fundamentals I've ever seen in a stock.
Now, in late February, Sirius announced that it wanted to combine with XM Satellite Radio in a merger of equals, a $13 billion deal. Now, Ann, do you think that makes sense for the two of these companies to merge together?
It really doesn't. I mean, the idea is that if both companies combine, they can combat the changing landscape of radio and other competition like MP3 players and terrestrial radio to become profitable, as both companies were in the beginning of the 21st century. But how can they make profits if together they'll be paying billions of dollars to celebrities to run these radio shows? And how can they claim that MP3 players and HD radio is any competition for them? These are two already unprofitable companies that think eliminating competition will make them more successful. But all this merger will do is throw two moldy cheeses into one bowl.
And as a whole, how strong is the satellite radio industry, and is there any room for growth for any company?
I really don't think there is any room for growth. I mean, the main reason why these companies haven't had any competition and will most likely not continue to have competition is that companies have to have access to a satellite. Small companies and private parties just can't do that. It costs too much, and it requires a lot of proprietary technology on their part. Now, the main shortfall with satellite radio is that it's not local. The programming you hear is nationally based. Most consumers now want high-definition radio in their hometowns so they can get all the latest news, weather, and sports. Now, the United States has been the only country in the world to accept satellite radio. In other countries around Europe, India, China, and other countries, higher population density means more support of terrestrial radio. It seems more of a fad than a lasting trend. Most consumers don't feel that they have to pay for radio when they already get what they need from their local stations. Oddly enough, the largest subscribers are businesses, which use satellite radio to replace background music on phones and in office buildings.
Now, when looking at the numbers of both companies, which one is stronger, XM or Sirius Satellite?
Well, obviously, Sirius is in a spot of strength if it thinks that it can purchase XM. It's in the position to buy XM but not without incurring any debt. Compared to XM, Sirius has $150 million extra in cash, but Sirius's stock price has fallen 95% to only $3 per share since March 2000. Sirius does have the best personalities like Howard Stern, Martha Stewart, and Tony Hawk, which is why this is a better deal for XM in the long run if it's improved.
Well, Ann, how does Sirius compare to XM Radio?
Well, besides never ever posting a profit, XM lost 90 cents per share during the fourth quarter of 2006. Now, XM has seen a sharp downturn in its stock as well, but has garnered enough support to trade for a little more than 13 per share, meaning Sirius is going to pay 4 times per share as much for XM than its own stock is trading. Now, XM's Canadian satellite radio, which it owns 23% of, has fallen 50% since early 2004. So overall, all of the company's businesses aren't doing well. Now that makes me wonder why Sirius would want a company that isn't posting any profits and wants to put itself in a position of possibly going bankrupt in one of the worst M&A deals in history.
But Ann, even at Sirius's low prices, couldn't this be viewed as a buying opportunity, especially if the merger does take off?
That's a common misconception. Sirius's low price point does not mean that it's an attractive value right now. This is in no way an opportunity to buy on any dips. Now, while I do consider Sirius the stronger of the two, the reason I hate the stock the most is that it's not learning from its mistake. After technically going bankrupt, management is still making poor decisions. Sirius itself posted a net loss for the fourth quarter of 17 cents per share. You just can't trust a company with poor fundamentals and earnings that wants to buy out its competition. To me, it sounds like shady business practice. Ironically, Sirius says that it expects $1 billion in 2007 revenue, which is banking on the approval of the Sirius and XM merger. I don't know if they're naive or what, but that's never going to happen.
Well, how likely is it that the merger will be approved?
Well, there's a lot of hoop jumping that Sirius is going to have to do for this merger. First of all, it must receive approval from both the Department of Justice's Antitrust Unit and the Federal Communications Commission, or the FCC. Now, Kevin Martin has said that the barrier to this deal between the satellite giants would be extremely high, and that as a merger of equals, terrestrial radio may oppose the deal. Now, if the Justice Department and the FCC do approve the acquisition attempt, shareholders that are still on the books, which in my opinion will not be many, will have a chance to vote on the measure in 6 months. Now, former Attorney General John Ashcroft has condemned the deal as a monopoly, as he was hired by the National Association of Broadcasters to examine the deal.
If the merger isn't approved, is there a chance that Sirius could turn around and become a strong company?
I mean, it could be possible. If the merger is not approved, it still has some choices with what to do with the money that it currently has in pocket. Now, the company could try to revalue their stock through stock buybacks. Now, the main reason that I'm opposed to this merger is that Sirius could be doing much better things with its money than acquiring its rival and beating it at its own competition. Now, Sirius could beat the pants off of XM if it looked in the right places. Instead of committing to a horizontal merger with XM, Sirius could have looked into a vertical merger. For example, one of Sirius's marketing partners is Dynamic Media. It's a premier provider of Sirius satellite radio and also happens to work with XM. Now, the company specializes in designing and installing Sirius business systems for every zip code in the United States. Why doesn't Sirius buy that company out for itself? Not only will it have control of its own marketing partner, but it would be operating in the small niche sector of messaging and background music that Dynamic Media deals with currently. Or it could buy out Directed Electronics. This company is a key hardware partner on Sirius receivers, tuners, interfaces, and accessories in both the home and mobile electronics aftermarket. This company only contracts with Sirius and not XM. Now, these types of deals would make Sirius much stronger than XM and drive XM into the ground, along with its profits.
So, Ann, in your opinion, what's the future look like for both of these companies?
Well, if current shareholder actions are any indication, this deal will not be approved, and Sirius and XM will most likely go bankrupt. It really doesn't look good for Sirius at all. I mean, Sirius has already been downgraded to market perform, and I would expect to see a few more of those downgrades in the future.
So your advice to viewers, basically the bottom line is?
Do not buy Sirius as a buy on the dips opportunity. This isn't one of those instances. Even though some companies are good buys at $3 per share, that might be $3 that you're just never going to get back. And that means a lot if you could invest into a worthwhile stock that would give you better returns.
Well, Ann, you've painted a bleak picture for Sirius Satellite Radio and actually the whole satellite radio industry as a whole. You know, but listening to what you say, it sounds like you're right on about this particular one. Thanks for sharing the information.
Thanks, Sandy.
If you'd like more information about Diligent Investor, you'll find that available at taipanfinancialnews.com. I'd also like to point out that Ann contributes regularly to Dynamic Market Alert and Market Report. Both are free daily e-letters. Sign-up information is available also at taipanfinancialnews.com. Thank you for watching Stockbusters. I'm Sandy Franks, and I'll see you again next week.